a double delight on the economy in terms of the data that has come out for the month of December. Inflation has dropped and IIP has increased. The big question, has inflation peaked? India's headline retail inflation for December dropped to 5.72% from 5.88% in November. The number is below the consensus which pegged CPI to come in around 5.9%. This is the third month in a row that India's inflation has fallen. While inflation has dropped below the RBI's upper resistance band of 2 to 6%, it is still higher than the central bank's 4% medium-term target and has remained above that number for 39 months in a row now. ET Now's consulting editor Maithili Bursumath first breaks down those numbers.
Well, the government is having a bonanza of good news after the good news we saw last week on the GDP front, where the GDP growth numbers for this year, the advanced estimates put growth at 7% as against the RBI's number of 6.8%. Today, the government got a bonus by way of inflation coming in lower than estimates and the industrial production, index of industrial production coming in way higher than estimates. Inflation for the month of December came in at 5.72 as against 5.9 for the month of November, lower than the estimates, most of which were in the range of 5.9%. As against this, we saw in the case of index of industrial production, we saw the index of industrial production, which had contracted by 4% in the month of October, actually increase in the month of November. So November IIP moved up to 7.1%. And we saw manufacturing, which is where jobs come from, which had contracted in the previous month. In the month of October, it had contracted by 5.6%. As against that, manufacturing grew by 6.1%. Even better, capital goods, which is basically investment and which lays the foundation for further growth in the economy, increased by over 20%. So all in all, very good numbers for the finance minister as she goes in the final lap of the preparation of the budget. Remember, these are the last numbers that she gets before she presents her budget on the 1st of November. So we're really having a bonanza, as I said, of good news after a long time of bad and dismal news. So clearly, chance for us to cheer.
And to speak more on the numbers, I'm joined now by Madan Sabnavis, Chief Economist, Bank of Baroda, Garima Kapoor, Chief Economist, Elara Capital, and Madhvi Arora, Lead Economist, MK Global. Welcome to all of you, and thank you so much for speaking with us today. Mr. Sabnavis, let me come to you first on the numbers. Definitely great news, isn't it? Great way to start off the year.
Yes, I think given that there has been not so happy a picture the whole of 2022, ever since we have the Ukraine war, talk of a recession in the West, I think these particular numbers which come out, at least statistically, look very good. I say statistically because statistically, yes, inflation has come down and probably continue to move in the downward direction to remain above 5% for the rest of the year. So that's good news. The same thing holds for IIP. While we would be clocking in good numbers, but if you just juxtapose that with, say, what the GDP data had to say about manufacturing, which speaks of a growth of just 1.6%, it actually does present an ambivalent picture. So in a rather guarded manner, I'll say this is, of course, good news in the statistical sense, though there's probably a lot more which has to be done on the economic front to make sure that industrial growth remains robust in the coming months.
Let me just talk specifically about inflation, and I'm coming to Garima Kapoor here. 5.72%, that means it's under the RBI's tolerance band for a second month in a row. It was 5.88, the CPI, that print last month. And that was also after about 11 months. Now, I remember when we had hit the 5.88% figure, the questions were, is this sustainable? Are we beginning to see that trend now in your view?
So what we saw in today's print is largely on expected lines, except for the fact that the magnitude of correction of food was larger than expectations. These are typically the winter months when food inflation tends to correct because of this inflationary trend because of the arrival of the Kharif crop. And if you look at the high frequency data for the month of January, my expectation is that you should also see a sub-6 print in the month of January as well. So you will actually comfortably undershoot not just this quarter, but next quarter's estimates of RBI. And if RBI at 6.7%, you will have an undershooting of at least, if not 20, at least 30 basis points thereabouts. So while we can rejoice these numbers, the internals don't look very good. The core inflation has remained fair about sticky, hovering in the range of 590 to 610 for a very long time now. And the recent RBI policy, MPC has quite elaborately, kind of given a fact that they also need to see core inflation trends come down sustainably. And that picture doesn't look quite rosy. So although the headline is comforting, largely led by food, which was also a worry 6 months ago, it's somewhat a mixed bag if I take into account the services and core inflation.
Right. So the core inflation number, and you're absolutely right, is at 6.1%. In December, it was 6 in November, and that is still, displaying signs of sticky core inflation. That's an issue. Madhvi, Arora, do you concur with that overall view? Then the number looks pretty, and I'm talking about inflation right now. The inflation print looks nice, but the internals point to a little bit of rough weather still coming ahead.
Specifically for the core inflation bit, where Garima mentioned that it looks to be a sticky component. Clearly, the pricing power also seems to be remaining quite ample at this point in time. If you look at the PMI numbers, which shows the breakup of input price and output prices, both of them have been actually increasing. So the sense is that the core prices could still remain a risk going forward, even though the base effect would allow us to see a gradual decline by core inflation, specifically for the end of the year. But over the medium term, if you do see a demand-driven pressure continue, I think the core inflation could remain elevated. And I think to that extent, it's very important to see how the fiscal really pans out for the next 1 year, domestically as well as even globally, because we are looking at a change in global regime in general. So that I think will have spillover to both fiscal and monetary policymakers around the world and back home as well. And which of course will have implications for inflation, downtick and uptick, wherever we find our balance.
Okay, so a measured sort of response coming in on that CPI figure so far. Let me move to growth and the IIP number. It's again looking fantastic year on year, but that's probably base effect acting in. When you look at the internals, Madan Sabnavis, what's the story that emerges as far as the IIP number is concerned?
See, one trend which we had seen earlier also was that all the industries which are related to infrastructure and finally to what the government does in terms of spending have tended to perform better. This really comes out from the core sector data, which has shown that industries like cement and steel have tended to do consistently relatively better than the other segments. But today, when I'm looking at even the consumer goods segments, both durables as well as non-durables, we have seen an uptick, a positive growth. But of course, it comes over a negative growth rate. And this can be probably explained by the fact that there was this pent-up demand story, which really did unfold during this festival time. And it's something which probably will start getting diluted as we go ahead. So while overall the number does look good, and maybe for the entire year, we could still be ending up with a number of around 5 or maybe even a little higher than 5%, 5 to 6%. But I think the industry kind of performance within the entire manufacturing sector, looking at specific industries, I think that's what should actually be catching our attention. And yet the last point I'll make is that so far in the first and second quarters, looking at the financial performance of the manufacturing sector, we haven't really seen a rosy picture. We've actually seen profits decline, which means that your value addition has actually been growing at a very, very marginal rate. And that's really what gets reflected in the GDP growth numbers. So numerically, again, yes, it's a good number. Probably it's a good thing for the future, but I wouldn't really rejoice too much on this particular number.
Garima Kapoor, are you feeling as skeptical?
I would partly concur with him, yes. But I do think going forward, the way we look at the growth numbers, they're going to change. One, on the value addition bit, I think the current quarter in which the results have started to get announced, you will see margin improvement of companies. So the quarter 3 numbers, especially for manufacturing GVA, should start to look better compared to the previous 2 quarters, where the margin pressures was really intense. On the second bit is that the pent-up urban demand is now probably at its end. We've already seen the goods pent-up demand peak out a long time ago, and services probably is nearing its end. But we've seen some nascent signs of improvement on the rural bit. So going forward, it's quite possible, because of high crop realizations, as well as the expectations that that your inflation, especially wholesale inflation for inputs, which the rural folks generally use, has started to come off, you'll probably see terms of trade and rural economy slightly turning better. So probably you will see the shift of pattern of growth where next year the rural economy will start to relatively outperform the urban economy, and they will thereby somewhat balance the negative impact that you'll see from external headwinds due to exports growth slowdown. So net, you will see certainly a much lower growth going forward, but you will have some internal balancing factor for the factors that I just mentioned.
Madhvi Arora, when we come to the IIP number, and statistically it's looking great at 7.1%, what do you think are the sort of sectors where we're seeing the most growth? Capital goods output, for example, at 20.7%, again on a negative base, like Madan did mention. But are we now seeing signs of robust, sustainable growth through the year?
So again, these IP numbers are quite patchy. I don't think you should just make any trend analysis by seeing one data point. I mean, if you just look at the variance in the forecast, it's extremely funny because you would see the numbers varying from a 0% to a 7-8% even in our own forecast, and it's as the variance is extremely high even when you see the distribution of data that comes. So I would be very wary of reading IP numbers as a precursor to how the growth in general is looking. Of course, this time around, because of the base effect and the fact that the Diwali effect sort of has spilled over better into November month, you are seeing a relatively better number. But I think you need to average out both October and November numbers to actually get a sense of IIP in general. And if you take that into account, so last month we had printed a minus 4.2%, and this month it's a 7% plus IIP, that still comes out to be an average of hardly 1.4% in general. So I don't think that one should rejoice it way too much. And of course, going ahead as well, I don't think that we're looking at any secular driver of growth which could actually drive us towards even a 6% plus growth in FY24. While I agree with Garima that the rural story could be a next cyclical play for us. But, if you see rural sector for the last 2 years or so, the biggest problem that the sector has faced, even in the terms of trade point of view, as well as in terms of the income aspect, the rural incomes actually have been coming off. On a real basis, they have been generally hovering around close to plus to minus 2% on an average. And unless, of course, you see a secular increase in the rural income in general, which I think would be a difficult play because the kind of employment shift that you have seen in rural sector, essentially from a high paying or high productive service sector to a low paying and highly disguised employment based agriculture sector, the overall income of the rural sector itself has come off. So I think to that extent, rural may not remain a secular play for the economic consumption model going ahead. And I think generally incomes across rural and urban will probably come off during the year. So my sense is that, you are going to be struggling to find any secular, agent of economic recovery going ahead. And we'll also be seeing some global drags in the form of still elevated prices, even though they're coming off sharply. We'll also see some kind of hit on corporate profitability, and of course, demand curbing monetary policies and diminishing global growth prospects. All of it will weigh on output as we go into the next year. So I think unless we find a next level of secular demand or secular growth, I think I would be wary of talking about a 6% plus kind of a growth figure for India next year.
I think the last calendar year at least has made everyone very circumspect and a little wary of making predictions, because last year this time we didn't know we were going to enter over 12 months of global crisis in terms of a war, which is still going on. And perhaps that's right. We don't really know how things are going to pan out. But speaking specifically on interest rate cycle and the indicators we're getting from here, Madan Sapnavis, do you think that this is going to impact the rate hike cycle as far as the RBI is concerned? What do you see happening there?
In my view, the RBI will probably continue with one more rate increase in the month of February. So they could reach 6.5%, after which there could be a pause. That could be a longer pause, depending upon how the inflation numbers look. Because we should remember that the inflation numbers have been affected a lot by the base rate. And when the inflation number moves on the basis of the base effects, rather, it is not a very convincing thing as far as the Monetary Policy Committee is concerned. So they will be looking at the internals, when you're looking at the core sector, the core inflation number is sticky, will continue to be sticky, given the fact that a number of corporates in their discourses have mentioned that they are still in the process of passing on the higher input costs. So as long as this process is on, this particular component of inflation, which is more influenced by monetary policy decisions rather than food inflation, would be something to be closely watched by the RBI.
Do you concur with that, Ms. Kapoor? One more hike and then a pause?
Yes, I totally concur with Mrs. Abnavis. And two things to watch out for in the near term. One are going to be, of course, what is going to be the impact of China's reopening on global prices, particularly the metals basket. We've seen some of the metal components already having rallied in anticipation of normalization kicking in from the next quarter. And the second thing is going to be an expected or anticipated cut in petrol/diesel prices if the headline crude prices stay here. Remember, the under recoveries have now turned to over recoveries over the last 15 days, but they still have to cover up the losses for last 8 to 10 months. So we don't see petrol and diesel prices correcting at least until the first quarter of 24. So these two indicators, in my view, along with anticipation of what's going to happen on the demand bit, which could have a significant impact on core inflation, would be 3 points to watch out for. But given today's print, despite the sub 6% number, I think a sticky core inflation and a 572 still calls for 25 basis point rate hike in the month of February. And currently, I'm on a prolonged pause for most of FY24.
Okay, that's interesting. Madhvi Arora, 25 basis points in Feb and then a prolonged pause. You think that as well?
I think all of us are on the same page in this.
Okay, that's great.
I think we'll have to wait, because I think a large part of it will depend on how the global policy repricing really take place, because everybody's very closely watching the global pace of inflation of evolution and how the impending recession will shape the developed markets, central banks' policies, which obviously will have implications for emerging markets, including that of India. So I think at this point in time, everybody is going by this view that, of course, our domestic inflation dynamics are looking to be relatively better. Globally, disinflation is now the next big theme. We'll have to see how fast it actually plays out and where it actually settles in terms of, the new normals of inflation that one is talking about, and what it really implies for the central banks across the world. So I think to some extent we are prisoners of the West, and let's not pretend that we aren't, because we clearly are. And we can talk about, and we can actually see that, divergence within the external members of the Reserve Bank, MPC, and the internal RBI core guys, and the way they are looking at the same scenario very differently, because the Reserve Bank actually has to manage not just inflation, but a lot of parameters, including that of financial stability, which obviously gets impacted by the movement in our asset prices in general. So I think they're looking at a more holistic picture at this point in time. That is why, despite the fact that all of us are talking about RBI just hiking one more time and probably pausing from here on, I think Reserve Bank is also cognizant of the fact that they will have to play the Fed game as Fed probably either prolongs its rate hike, its rate stance at this point in time, or probably goes even into a reversal. Probably central banks will be largely following suit on that front. So I think to that extent, my sense is that yes, we are stopping at another 25 bips or so, but I think we still need to be wary about what is happening around the world, because that will clearly have implications for us, whether we like it or not.
It's interesting. It's a wait and watch, but for today, for now, this set of numbers are definitely looking good. The internals show that we're not out of the woods as of yet. Thank you so much to all of you for joining us on the show today.
Thank you.